Welcome to the Power and Market Report. I'm Albert Liu. I'm joined now by Adrian Day. He's the chairman and CEO of Adrian Day Asset Management. He's also the author of Investing Resources, How to Profit from the Outsized Potential and Avoid the Risks. Adrian, welcome back to the program. How are you?
Well, I'm fine, thank you. How are you?
Very good, very good. Since we last talked, there's a lot that's happened. We actually got our rate increase, albeit a very small one, but the Fed basically directing the market to future rate hikes. Last year ended down. It broke a multi-year high streak for U.S. markets. What are your thoughts on that?
Yeah, first of all, the rate hike obviously was just about the most well-publicized in advance, most forecast rate hike in history. So it shouldn't have come as a surprise to anybody, and the fact that it had any impact on any market is really quite astonishing. What we see with the U.S. stock market, I think, is a market that is overvalued, but not, in my view, as a market, not in bubble territory. It's overvalued, but not at the sort of extreme levels we saw back in 2007. It's also a market where the breadth is pretty narrow. And in fact, if you take out just 4 stocks, the S&P would have been down about 6% last year. That's pretty astonishing when you think about it. We also have a situation where the rally, as a former Fed member, Fisher, his name escapes me at the moment. How awful.
John Williams or Richard Fisher, both of them made comments recently.
From the Dallas Fed.
Yeah, Richard Fisher.
Richard, that's his name, yeah, Richard Fisher, mentioned that, the Fed had deliberately front-loaded a rally in the U.S. stock market. And so we had this huge rally in the market in 2009 and beginning of 2010, and it's kind of flattened out since then. So, on balance, I don't think we're necessarily going to see a collapse in the U.S. stock market in the immediate future or in the near-term future. But I also don't think that the prospects for any kind of strong up move in the stock market are really present. So it's likely to be a year where the stock market meanders, probably with a downward bias, but nothing dramatic in my view.
It's an interesting comment, Adrian. You say we're not overvalued, especially compared to say where we were years ago. But that sort of presumes an all things equal arrangement. We have now a Fed balance sheet that's around $4 trillion. We have Chinese reserves up above $3 trillion, I believe. That wasn't the case back then. So if you consider or contemplate an unwinding of the balance sheet, then where does that put us in terms of the U.S. stock market?
No, I think absolutely. From a macro point of view, the world, as well as including the U.S., is in far worse shape fundamentally than we were back in 2007. And as you I'm sure know, despite all the talk about austerity that we had after the crisis in 2007, global debt levels in virtually all countries around the world have continued to move up very, very significantly. So debt in absolute terms, as well as relative to GDP, is significantly higher today than it was back in 2007. So no, I certainly agree with that. But I think that, to see a crash, you typically need extreme levels of valuation and a manic, following some kind of mania for stocks. Now, you saw that in 2006-07, where we had the sort of housing bubble. That was clearly a bubble, not just in subprime, but it was a manic situation. You saw that in 1999 with the tech stocks. And manias are recognized empirically, but they're recognized as much anecdotally as by data or hard evidence. And there's just no evidence today of a mania in the stock market. I mean, if On the contrary, most individual investors are pulling money and continue to pull money out of the stock market, other than the 401s, which tend to be, company-run, company-driven. But if you look at retail investors, as evidenced by mutual fund inflows, money's coming out of stocks. So there's no broad mania in the stock market, in my view.
What about in sovereign debt? Certainly the appetite there is somewhat bewildering, given the poor state that a lot of these countries in, and now throw the U.S. in there with it. It's still seen as a safe haven asset, but is that really the case? Should we be concerned about a bond bubble?
But I agree with that. I agree with that completely. And I think, if anything, bonds are in a bubble, and particularly sovereign debt. But I guess the situation is, people feel, both institutions and individuals, they sort of have to put the money somewhere, and they're reluctant to put the money into the bank, into CDs, where they're hardly earning any money. If you were planning on a 4% for your retirement, or your pension fund has planned for 4% or 5%, and you're not getting that on short-term treasuries or CDs, you've got to, people feel, wrongly I think, but people feel that they ought to take additional risk in order to get some kind of return. Sovereign debt, as you said, is seen as the safe haven. People think they're doing the conservative thing, the safe thing, but on the contrary, you should analyze, when you're looking at a sovereign bond, you should analyze the financial health of the country, of the government, in the same way that you would analyze the financial health of a Nestle or a Apple or whoever else's bond you might be buying. I would far rather own bonds of companies like Nestle or Apple than I would of the U.S. government. And incidentally, just as a tangent, Apple now has more cash on its balance sheet than does the federal government, which is pretty astonishing. But anyway, I agree with you completely. But of course, sentiment, and we'll talk about this perhaps with some other asset classes, sentiment becomes a self-fulfilling prophecy, if you like, a self-fulfilling factor until the sentiment turns. So if people believe that government bonds are a safe place to be, more and more money flows into government bonds because stocks are considered, higher risk and expensive, because banks, CDs are not paying much. And so government bonds continue to attract money because it's considered a safe haven. And at some point you run out of buyers, of course, but until that happens, or until sentiment changes, then sentiment becomes self-fulfilling.
You mentioned that you don't see a mania in stocks. We both agree that perhaps the biggest bubble is in sovereign debt. But there are a lot of little bubbles kind of hanging around, none of which perhaps on their own is big enough to implode the economy. I'm talking about, for example, the high yield market, other even corporates. I think we're seeing fund outflows now. There's a student loan bubble, albeit these are smaller, auto loans. Do you see any of these as being particularly dangerous?
I think when you add the whole debt situation together, it's very dangerous. I mean, I think the U.S. economy fundamentally, underneath all the headlines, is really in a very precarious state. You mentioned student loans. That's one issue. But you look at all of the you look at the total debt situation of households in the United States, and it's in a very serious situation. And again, it's worse than it was in 2006, 2007. We should have seen a significant improvement. But household debt levels relative to income, relative to net worth, are at record levels. And the plain fact is that most people, if you look at surveys of people in their 50s, the majority of households don't have any savings. No savings at all, or minuscule savings. And for a lot of households, the balance sheets are negative because of debt that, like student loan debt, that basically just hangs over you for your entire lifetime. Or look at credit card debt, where a lot of credit card companies are charging 25 to 30%. If you're charging 30% on a daily basis, on a daily you know what I'm saying, interest accumulated on a daily basis. Paying minimums is not moving you very far ahead. You have a 30%. Let's say you have a $20,000 balance and you've got a 30% rate of interest, and your minimum payment they ask for is $600. About $150 is reducing your debt. The rest is just getting to pay interest. And so those sort of debts, if you can only afford to pay minimums, they go on for not just years but decades. Another interesting sort of way of looking at this is looking at household income or household net worth, and the statistics are pretty close for both of those, for income and for net worth. You see that the government, the Fed, actually 18 months ago and then 12 months ago made a fairly big deal about the fact that in the first case net income, in the second case net worth, had moved above the record levels of 2007. But if you dig in, and that's true on an absolute basis, on a total basis, they're now at record levels. But if you dig into those numbers, you see that in fact it's only the top 10% of the population in both income and in net worth that have really moved up at all from 2007. For the bottom 50% in both income and net worth, they are worse off today than they were in 2007 by as much as 20%. That's dramatic, and that's significant. And I think that's part of the reason that we had the Occupy Wall Street phenomena, and it's also part of a reason for the Trump, surge in the Republican presidential campaign. Because, you might think, well, Trump and Occupy Wall Street, they're about as opposite as you can get. But really, both phenomena, I think, derive from a sort of anger and a frustration that people are working hard and they're just not moving ahead. And that's very dangerous, I think. It's dangerous politically, but it's also very dangerous economically.
Yeah, and you cite household net worth. These aggregates, they really lose their meaning when a lot of the wealth is being generated by basically asset price appreciation on assets that a lot of people don't possess, right? It's just a fraction of the population that's actually holding these assets.
Absolutely.
Adrian,
well,
go ahead.
And you see that, and the fault of this, you see this every time you have a dramatic easing in monetary policy where money expands dramatically and interest rates decline significantly. Money flows, first of all, that excess money flows first of all to the wealthiest. It doesn't flow to Main Street at all. And of course, we know that, and I don't mean to sound like a socialist because I'm not, but we know that back in 2008-9, that was the whole point. The whole point was not to save, Joe Sixpack in Des Moines or wherever. The whole point was to save the banks and to get money into Wall Street. And they succeeded. If that was their goal, they succeeded eminently. But they didn't succeed for the mass of the population.
Right. Let's move to 2006 now. We had the worst start in the stock market here in the U.S. in over 100 years. On Friday, the VIX hit 28 or exceeded 28. How serious do you think this is? Do you think you don't think we're going to have a collapse, but are we going to actually go into an official bear market this year?
I think we could. But I'm fairly sanguine on the U.S. market, as I mentioned. This was sparked, of course. There was nervousness, there was overvaluation, there was, concern about interest rate hike, and it wasn't so much the interest rate hike, of course, which, as I just mentioned, everybody knew was coming, but it was the fact that when you looked at the dot plot that they do, it signaled 4 interest rate hikes this year, and of course some people, including the Deputy Chair Fisher, have talked about that, but we're going to get 4 hikes this year, and I think the market wasn't ready for that. So there was a sort of nervous background to begin with, and then what happened in China with the circuit breakers, which are just about the most idiotic thing imaginable, but that's a different topic. And that just spooked everybody and set off these declines. One thing I will say about the Chinese government, they're pretty quick learners, and after using the circuit breakers twice in 1 week, they realized they weren't a good idea, and they abandoned their use. So no, I don't think we're going to see. I don't think we might see a bear market, but we're not going to see a crash this year, I think.
Okay, let's turn to China because you mentioned it. I think that's what everyone's worried about, actually. The negative sentiment persists. You mentioned the circuit breakers. Twice they exceeded 7%, which automatically triggered these things. And of course, we use them as well, maybe at different thresholds, but we certainly have mechanisms like that in place here. The problem, I guess, is that trying to circumvent a crash like that actually makes the problem worse in the sense that it triggers a capital flight. So
absolutely.
Is that the problem that you see as well?
No, absolutely. I mean, it's any time that a government or exchange, for that matter, interferes with the free market, it causes distortions. In this particular case, people who are thinking of selling suddenly think they better go ahead and sell because they might not be able to in half an hour, or they might not be able to tomorrow. So it's the same with exchange controls. I mean, currencies can be weak for a long time, and some people put their money outside the country. But you then put on exchange controls to say people can't do it, and everybody tries to figure out ways to do it. So it's best just to let prices fall to their own levels. And, I think in China you have a situation where the Chinese stock market got into a bubble last year. We had some easing of that bubble in the spring, but the prices didn't really go back as far as they should have done because of, again, government intervention to support the stock market. And so it would have been much better if last spring, early summer, stock prices in China had declined even further and get rid of all of the excess speculation, and then it would have found a firmer footing to move up. So, I'm not particularly. I'm not interested in the China. When I say I'm not interested, I shouldn't say that. What I mean is, I don't have any interest in buying Chinese stocks at the moment. I think we've got more air to get out of that market. But I am more sanguine on the economy, and I don't know if you and I will agree or disagree on this, but I know there's a lot of discussion about how accurate Chinese statistics are and so on and so forth, and we could actually make some of the same arguments about U.S. statistics for that matter. And by their nature, government statistics, or not government statistics, economic statistics are going to, by their nature, give certain sort of misleading perceptions. GDP itself is a flawed concept in many ways. And perhaps we don't have time to go into that. But if you look at the Chinese economy, it is clear to me that it is growing. If we look at 6.5, they're talking about 6.9%. If we look at 6.5 to 7% economic growth, that is very, very powerful economic growth, especially when inflation is at relatively low levels, sub 2%. We're talking about decelerating rate of growth in China. We're not talking about negative growth or recession. When you go to China, I was just in Shanghai, only Shanghai, unfortunately, but I was in Shanghai in December, and this is clearly a thriving economy. I mean, you just have to look around, go to restaurants, try to book restaurants, etc. I mean, it's not as crazy as it was 5 years ago, but it is still a thriving economy. And let's not forget that 6.5% manufacturing is weak. You know, that manufacturing sector is weak, no question. But most other areas of the economy are doing quite well. And if you look at 6.5 to 7% growth today, that is in absolute terms more real value created than 11%, 7 or 8 years ago, because of the bigger size of the economy. So I'm fairly sanguine on China's economy, to be honest. And I do also think that setbacks, anytime you have a country go from a basically rural economy to an industrialized, urbanized economy, particularly over such a short period of time as happened in China, you are going to get setbacks, both economic and also, political and social and everything else, pollution, etc. So, I think some of the criticisms of China that you read about are really quite ludicrous. Countries need to look back at their own history, and I think of England, for example. We had an industrial revolution from 1780 to 1840. Really, was the big industrialization. And think of all read the novels of Charles Dickens. I mean, they're novels, but look at the conditions in the poor laws in the homes for poor people. Look at we sent children of 7 and 8 down underground and up chimneys, down in the mines and up chimneys. And, so when people criticize the conditions in factories in China, I think they should think back, on their own history. And those things will change. When a country goes through that kind of industrialization, economic growth, and prosperity, economic advancement is the number one objective, both for the government and for individuals. That's what they want. They travel from rural areas into the towns to get jobs, and they're looking to advance their economy, and other things like the arts and pollution and liberal causes and so on are less important at the beginning. But at a certain point, and it's different for different people, but at a certain point, when you've achieved a certain level of prosperity, then these other things become more important. And we're seeing that already in China, where the discussion about pollution is now one of the leading discussions, both in the newspapers, at the government level, in restaurants and cafes. That's what people are talking about, and how to solve it and how to stop it. 10 years ago, they didn't really care about it because they wanted advancement. Now they do care about it. So I'm fairly sanguine on China.
I agree with you in the sense that this is a parallel history, and like Jim Rogers says, they're going to do fine in the long run. In the short run, they're going to have some setbacks. But if you look at the history of the U.S. and England, the same could be said there. Some of those setbacks are pretty serious setbacks if you happen to be unfortunate enough to live through them. So that's right. Well, that's one concern. The other concern is contagion. So I'm thinking about the stock market. It's taken a big hit, obviously, to the extent that markets aren't even real inside China. I guess that we don't have to worry about that. Banks can't invest directly in the stock market, so at least on balance sheet they have no risk. But what if this becomes a credit issue? Isn't that a problem? And because for one thing, the capital flight, people exiting stocks, exiting the yuan because they fear another devaluation. I sent you an article yesterday, Adrian. Some of that money appears to be going into Vancouver commercial real estate and other real estate markets around the world. A capital flight could cause a problem for the banks. And one gentleman inferred that from the roughly 500 billion FX reserve drain they had last year, that the capital outflow was about $1 trillion. And not all of that was capital flight, but still, that's a pretty big number. Should we be concerned about credit issues and the contagion from China to other markets?
Yeah, I think so. But I would also say that credit issues in China are different in different areas and for different people. Until recently, as you know, when you bought a car in China, you put 100% down. You didn't buy it on credit. Very few people in the United States today buy cars with 100% down. Most people, do take a loan for a car, let alone for a house. The down payments for houses in China are much higher than they are in the U.S. and Britain. So I don't think most individuals have the kind of credit issues that, say, the government and the big banks have, and some of the real estate developers. They have credit issues, no question. But the thing that I guess is a big concern is that if you look at look at this whole decade, China has been the engine that has driven global economic growth. Since the recovery of 2008, I think has been responsible for about 50% of the world's GDP growth. But if you go back over the last 15 years, excuse me, it's actually responsible, given some countries and some areas like Europe have been in recession for much of that time, it's actually responsible for 100% of the world's economic growth since then. So if you think that China with a fifth of the world's population and 6.5% economic growth is responsible for most of the world's, or a good part of the world's economic growth today, that is a concern. If the Chinese economy were to slow even more, down to the 3 to 4% growth rate, it's unlikely to go into a recession, in my view. But that would be a big concern because other areas, including the U.S., are really not, as it were, pulling their weight. So yeah, and the issue you raise, I think, is also a valid one. That with the yuan declining, albeit moderately, and on a sort of 20-year picture from a relatively high level, but nonetheless with the currency declining, with people generally not having a great deal of confidence in banks. I think that's true. Certainly, when I was there and talked to people anecdotally, banks don't seem to be held in very high regard. That could lead to a big issue for the banks. The government, in my view, would be likely to support the banks, just as the U.S. did. So I'm not sure that we're going to see large numbers of Chinese banks go bust, but it'll come from reserves or it'll come from money creation.
Adrian, we're running out of time, so before I let you go, I just want to get your thoughts on energy. We have oil just plummeting last year and then the first week of this year as well. And the interesting thing is low oil should be very good for the economy in general. I just filled up my car for $1.49 a gallon here in Houston. That should be a good thing, but that's not the narrative we're hearing. This is seen as a bad thing. People are focusing on the losers, and I believe it's because we have so many bubbles brewing that a shock like this is really going to hurt. Where do you think this is going to end up? Because clearly $32, $33 is not sustainable for a lot of oil producers.
No, absolutely not. Well, I mean, the issue you brought up at the beginning is an interesting one because, of course, with anything, with a strong currency or weak currency, high oil, low oil, there's always winners and losers. And I think we focus on the losers with oil because the oil prices come down so dramatically, so fast. If it had been a slower decline, a much more moderate decline, then I think we will be focusing more on the winners. I think one of the things we've seen, obviously, we know about Saudi Arabia and Russia. Russia's pumping oil at record levels. Saudi Arabia is stepping up production, so we know all about that. And what we didn't see for quite a while was you would expect with lower prices, you'd expect a sort of production, a supply response. But with, as you know, with resources, supply responses to changes in prices tend to come with a lag time. And what we saw in the U.S., for example, was the amount of production and the number of rigs running all the way through the end of 2014 and all the way into the spring of 2015 actually increased. Even though the price had declined so significantly, we saw production step up. Now we're beginning to see that in the last few months, we've seen that come back very, very dramatically, and particularly not just on the production, because some of that's already baked in the cake, if you like, but if you look at the number of rigs, the rig count has gone from over 1,400 at the beginning of last year to about 530 at the end of the year, according to Baker Hughes, the authority on the rig count. That's from 1,400 to 530. That's very, very significant. And so what that means is that we're already seeing lower production, lower output in the U.S., but that output's going to drop fairly significantly over the coming months and year. And then the market will slowly get back into balance. So, like all things, low prices are the solution to low prices. It leads to cutbacks and it leads to increased demand. People drive more, as you say. You can fill up your tank for less, so people drive more, etc. You have less incentive to switch over. You buy cars that use more gasoline, etc., etc. And so, all of this comes into the supply-demand equation, but it takes a while to do it. So I think the market will get back into balance, but it probably won't be till next year, frankly. I'm not particularly positive on the oil price at the moment because of the oversupply.
Speaking of losers, Adrian, there have been several losers in the currency space due to this commodities rout. You have the Canadian dollar, South African rand, Aussie dollar. They've been victims of this. Do you see that turning around?
Well, I think you need the commodities to turn around for all of the commodity currencies to move up. But I think you should let's separate Canada and Australia, particularly Canada, which have pretty good government finances, as government finances go. They run pretty good government finances, and certainly separate those from South Africa and Brazil in particular. So I don't see a lot of near-term hope for Brazil, frankly. But Canada, I think the currency's at an extreme level at this point, but it really needs a firmness in some of the commodities to rebound significantly.
I've been speaking with Adrian Day. He is the president of Adrian Day Asset Management, and you can find him at adriandayassetmanagement.com. Adrian, it's been a pleasure speaking with you. Let's do it again soon.